Hey guys, in this video I'm just going to show you an indicator that I made. I made it from scratch, so I coded it in Pinescript. I'm not actually that great at Pinescript, but I just kind of played with it. Just called some functions and all that. It wasn't that hard to make, actually. It's pretty much just simple logic. So what it is I'll show you. So it works good on a higher time frame. So let's go for 1 year. So TradingView does 1 year candles now. They do 3 months, 6 months, and 1 year. Before they used to have to pay for that. So I guess they decided to make it free, which is cool. Because it actually works perfect with it. If it works perfect with big candles. So I'll show you why. So let me just bring this to the front. So it's called DAHA. It's that white line. Basically it's a moving average. But the thing is, it's a never before seen moving average. It's never before seen, never before created. If it has been created, I've never seen it publicly created. It's a really simple concept. If you look at the code and you get it, you'll be like, wow, it's really that easy. So all I did was I took the current price and I added it to a 2-period moving average, in this case weighted. Which weighted makes it closer to the price. So the average is closer to the price, and that's what I wanted. I want something that's as close to the price as possible. So in this case, we have so let me turn the volume off for a sec. So what happens is that in this year candle, obviously it's a long candle, it's not going to, the candle's going to stay open for the whole year, so you're going to see the price move around a lot. And you don't just need to use it on the 1 year. You can use it in conjunction with other charts like 6 month, 3 month, maybe 1 month, all at the same time, if you can see all those at the same time, or maybe just print some data from all of them. So I'll probably customize it in the future, but it's just a starting point. So what happens is this line, like let me show you a good example. So I'll go to like Ethereum or Bitcoin, whereas it will be a low, but it's like pretty close to the low right now. So what happens is, unfortunately, you might need a 2-year here because that candle's going to close anyway. So once it closes, it should still be far away from that moving average. But if not, next year you'll see the price move away. So what happens is you can use it as a mean reversion indicator. So basically, what happens is the price is going to drift away from that moving average, right? And it's closer than a 2-period moving average because it's DAHA, so it stands for day and a half average. So really it's like a day and a half instead of 2 days. So it's closer to 0. So that was the goal, to make it as close as 0 to possible. So if you could maybe get a stick, it's almost like a VWAP. Think of it like a VWAP, except there's no volume here. It's just a WAP. So you know what a VWAP is? Like the price. I don't use a VWAP. There's better VWAPs. Like you can use pivots for a better VWAP. But this can be used as a VWAP in that case where the price drifts away from it. You could see the price maybe like coming back to the average. So what happens is at this point it's showing that Bitcoin's really oversold in this case. So it's like it's drifted really far down. Like maybe you could buy some here at this level, and maybe get a trade back to like 21 in this case. And maybe you could even go higher, but you just want to maybe just set your target to like 21 in this case. You might want to set a target that like is like hard coded, so you just take this value 21,989 and you just be like, okay, well I'm going to sell at 21,989 whether it changes to 22 tomorrow or not. But anyways, that's what it does. So if we go to the 6-month candle, let's say during that 6-month candle we had a low down here. Right? Let's say we had a low at 15. Let's say we were at 15,000. Then we go to the 3-month candle. We say, okay, well we are also at 15. It's really low, and we're like, okay, we'll go to the 1-month candle. I'll be like, okay, well last month we were really, really deep, and we were far away from the DAHA on the 12-month, the 6-month, the 3-month, and the 1 month. even on the day, even on the 1 week, well, that's probably good enough, but you could start a buy position maybe. But even on, let's say, even on the 1 week we were down here, we were like, okay, well, we're red on all of them. We're far, far away. You can create your own ranges. Like you can take a certain, I don't, like, you're gonna have to create your own ranges, obviously. What I mean by that is, like, for like Forex, or like, for example, the Euro USD, you can be like, well, if it's like 200 pips away on the 1 year, the 6 month, the 3 month, the 1 month, or maybe 300 pips away, then okay, well, I want to go long because I think it's going to retrace back to the DAHA. But look what happened. Just look what happened. See how it was far away from all those averages at some point, especially here, because that candle was red and we were deep down here. Well, in that case, sometime in November, you could have started a buy position, and look what happened. We came back up. We started to come back up, and we'll probably come back up next year. Right? So on the daily, you could have been like, okay, well, sometime in November, here, on that candle, even on that candle, like, you could be like, okay, well, daily's kind of getting there. It might be kind of getting too close to the averages, because, well, I mean, like, on normal days, maybe it could be good, but on a, like, in crypto, especially in crypto, because it dumps, right? We talked about that, how it's risky. But in manipulated crypto, buying on the daily chart with the DAHA might not be that great. Maybe, because look, we were here and it came back up still. So at some point it was in this candle that has the fishtail at the bottom, the wick, that had a low of like 17,114. It eventually came back up to here. So maybe the DAHA was it's still useful in that case, even in a manipulated, risky market like crypto. But here you could have been like, okay, well, we're drifting away from the DAHA again, and on all time frames we're really far below the DAHA. So maybe we can be like, okay, well, we want to get a buy in and trade back up to the DAHA. So if you guys get the idea, right? So hopefully that helps. Check it out, use it. If you guys know any good ways to use it, let me know. It would be cool for it to actually become a real, like, script, that, like, indicator that people use in like 50 years. That would be crazy. I'm surprised no one thought of it. Like, I haven't seen anywhere like a 1.5 moving average anywhere. I think I came up with an idea to get 1.25, so I'll try to figure that out again, because that would be even better. I'm not sure what I did. I'll have to think about it. But if you can even get a 1.1 moving average, that means the price would definitely revert to a 1.1 moving average. Right? So in this case, let's say we were in January or February, and the candles are still far away. So let's see how it opens up next year. But anyways, next year at some point, of course, the price is going to move away a lot. So we could be like, okay, well, price is really low below the DAHA, which is really a day and a half average. In this case, it's going to be two candles, and it's going to be a candle and a half average. So it could basically be at one period. So I don't know, should I change it to PAHA, P-A-H-A? PAHA, probably not, because period and a half average kind of sounds dumb. But anyways, DAHA, like, if it's below here, we can get a trade back. So at some time next year, let's say we're in January, and this candle is real low, then we could maybe start to go on the 4 hour and be like, okay, well, I want to start looking at a buy position somewhere. Where can I get a good buy? And maybe here. When RSI is oversold, we want to start maybe looking around there. Something like that. So yeah, so I think it can be useful. It's still kind of a new thing. So we're going to see, like, for example, let's have a look at USD CAD. So we can see that in the last 6 months, we've had a high of 1.39. Recently, we've been at 1.37. In the last 3 months, we've come down quite a bit from the top. So let's just say that 3 month was green. we know that the 6 month is green. And the 12 month, let's say we were at the top, or we're pretty far away. Let's think of a range here. Let's come up with a range. So let's say in forex, for most pairs except for USD, JPY, we want because most of the prices are about the same, $1 something or like 70 cents, whatever. Except for JPY is like 130, whatever, 140. So anyways, let's think of a range for like most common pairs in the majors. Let's say, okay, well, this is the highs. Well, let's say we're in the 1.39s. We want to look for a short soon. We're green on 1 month, 3 month, 6 month, 12 month. We want to look for a short. I think we're getting high up on the average here. We want to revert back to that average some point later on. So we're saying, okay, well, we want to get some shorts in pretty soon. So let's say the 6 month was high. The 3 month was high. So in September we got a huge in September we had that DXY stop. We had the DXY strength slow down, right? So September rose up. Maybe it was on October for US CAD. But we said, okay, well, we're high and we want to start looking for a short here. We're pretty high. So yeah, so the DAHA was green. At some point this DAHA was green too. So this is looking like a probable short here, because we have so much room on that DAHA to show that we could probably get a reversion on such a close moving average. Think about it. This is a 1.5 moving average. We haven't even reverted back to the 2. We haven't even been, retraced to the 5 moving average. Right? Have you guys seen a moving average? Let me show you. So let's look at a moving average here. Let's say it's just a standard moving average, simple MA. I think this would be crazy. It could potentially be crazy, this indicator. So let's say, okay, well, let's say we got just a 5-day moving average. Look what happens. Over the course of time, this moving average trades below, it comes back up, it trades below, it comes back up, the price trades below, comes back up. Now look at the DAHA. Below, up, below, up, below, up. We're up. We were up here, came below, right? Think about it. Now we're on all frames. We're on the 1 month, we're up. Look, touch the 5, back and forth, back and forth, back and forth, back and forth, 5 moving average. We can go weighted. We can make that moving average weighted, and we can come back and forth, even closer to the price. Now, if we have a DAHA, well, we can definitely come back closer. We can definitely revert back to the price. So I think it's a cool concept. You guys should check it out. If you guys can, favorite it too, so we can try to get it out there. Maybe banks will start using it too, and it'll just get crazy. That would be crazy. So anyways, yeah, guys, check it out. Thanks for watching. If you guys like the channel, you can like and subscribe, and I'll see you guys next time. Take care.